Hi, Christofi here from Reventon. Very excited to be joining us today with Jon Rivera, the director of Urbane Homes, who has just under a decade of experience working for the family and also previously to Urbis. Thanks for joining us, Jon.
Yeah, g'day. How you going, Chris?
Very good, very good. Now, for everybody out there, we've got a very exciting presentation on the current property market. Obviously, putting into consideration the current climate with obviously the coronavirus, we can't escape it, and certain things that we've put in place and incentives to make it as close to a risk-free investment as possible in today's current climate. Now, obviously, putting into consideration what's going on, you can never have opportunities like that in a normal market. So we're excited to be able to present them to you. So what do you say about that, Jon?
Look, I think it's a pretty interesting time in the market, and obviously a lot of people are probably trying to get a bit of a crystal ball or already trying to see through what's going to happen. But my experiences in these opportunities, like I like to see these events as catalysts. And for residential property, I think there's some pretty big opportunities. So, for me in Urbane Homes and the family that I work with, we're pretty activated right now about what's happening in the market, Chris, and we're looking towards the future. And the good thing is that residential property, we believe, as an asset class, I think is something that a lot of people are going to be focusing on. We're already speaking to a lot of institutes at the moment who are very interested in particularly the Southeast Queensland market. And I think it's probably good timing to have conversations with our key relationships like Reventon to help educate and hopefully be able to clear a path for people in this time.
And definitely, as we discussed before, prior, and we have many times, affordability is key in any uncertain market. And after any massive global event, like especially what we're seeing now, property always comes out trumps. And I think it's important. Like I say to my buyers, it's important to know it's a long-term strategy. This isn't a 3 or 6 month get rich, get quick scheme. This is buying an asset class which can stand the test of time, and especially in the class that we're talking about today, which is very affordable in the 400,000 to 800,000 mark, will always be the truest asset class in my mind, especially.
Yeah, look, I think that's right, Chris, and you've really hit a note that we share in this as well. Is that residential property as an asset class is long-term, and I think one of the things that we always see is timing. I think where people really make the most wealth in residential property, and particularly in my experience in analysing the market, over 18 years, is that it's when you buy it is actually when you make the money, not when you sell it. So if you buy at the wrong time, like if you buy when everybody's buying, generally you don't make any money. But if you buy it when, and this is a whole Warren Buffett thing, but if you buy when nobody's buying, that's when a lot of people can obviously get a lot of wealth. And it always goes against the grain, but it's good hearing that you share those same fundamentals.
I laugh because Warren Buffett always do the opposite, and it's very important. I agree with that statement. I always think people go, you make money when you sell. I agree with you wholeheartedly, but I think you make money in real estate when you buy, but also when you sell. It's very, very important to understand the market, and we're not here property speculating. We're property investors, which means if we buy the right asset class, the right price point that has the right rental returns, that has good tax incentives and good savings, it's not going to cost as much to hold. And being in the current climate now from a lending perspective, being at 0.25% for the Reserve Bank, never been lower. It has never been a better time to have our money work for us in terms from a lending perspective. So you've got to consider all these factors as well, because you're hearing a lot of stuff in the media, doom and gloom, but are you putting all the factors together? Because a lot of people that are very active, and also, as we said at the start of this program, it's a great time to get some great opportunities and some great incentives in the marketplace, and some great opportunities, which what Reventon and Urbane have discussed, which we'll, at the end of the show, we'll discuss them in detail.
Yeah.
Now, I understand you've prepared a bit of a slide presentation for us, so I guess all of our buyers and our prospective clients will actually learn a lot about the Southeast Queensland market and also what real estate's doing now. So whenever you're ready, Jon, I'm happy to start getting into that if you're cool with that.
Yep. Yeah, thanks, Chris. I'll just share my screen now.
And I'll just chime in and ask some questions along the way as well. If there's anything, it's all pretty self-explanatory, but if there's any questions, I'll just clarify some points and ask you.
Yeah, absolutely. You can see the full preso there now, Chris, can you?
I can, it's all clear. You can see the bull at the top and Urbane Homes at the bottom. Thumbs up.
So look, this is a little bit of background on me, just for quick clarity, and I guess why I've been an analyst now for over 18 years, and I've I've been very fortunate. I got to work with a lot of different developers across the country in different markets around the world. And the one thing that I've always done is I've just focused on residential property. So, you know, Chris, when I've been very fortunate that this is like not my first time that I've seen some major catalyst events shape property. And today I want to be able to go through probably some of the things that I'm looking at, you know, with Urbane Homes and the family that I work with about what we're seeing in the future. So just a little bit of background about us, but I work for a lovely family called the Lynn family. They're a privately owned development company up in Southeast Queensland, stretching over a number of companies from Boulder Capital, Urbane Homes, Marquee and Elders. We from Boulder looking after finance and financing developers, obviously Urbane Homes, the building arm, the house and land arm, Marquee being a development arm, and Elders being a property management arm. So we sort of encompass a lot of things, and as a family, we're obviously very active in the residential space up there for over 35 years. So you know, really good breadth of the market. But for those that don't know Urbane Homes, obviously because we're not based down in Melbourne, we're very Southeast Queensland based. So everything we do there is a 4-bedroom, 2-bath, 2-car, 2 living. And we have some great warranties, which we're obviously very proud on. So 25-year warranty, 36 years on the roof, and 50 years on the frame, Chris. So really good stuff there that I think, you know, customers for, you know, and why we work with Reventon is that we offer quality at value. And that to us is really important.
And that's why we work with Urbane too. And that's all those things you mentioned is a good quality builder that actually backs their product, which is why it's very important for us as well.
Exactly. And look, one of my key roles is actually getting involved in probably this guarantee here, which, you know, the building side is quite a tricky space for a lot of people because, you know, if anybody's been building, to get a fixed price on something is actually quite tricky. And it's actually something that a lot of builders communicate, but don't really stick to. And part of my role and my research role is to make sure that all our customers are getting the best value. So we offer this as a guarantee. And it's not the guarantees that you were talking about, Chris, that you've sort of negotiated with us as a security, but more, this is what we offer as a standard. And that is that any market or any project that we're in, any community, we're going to offer the best value to that customer. And if not, we're going to match the price, and we're going to also give $10,000 off. So there's a number of these guarantees that we offer, but we really do stand behind, you know, what we do as a project, and you know, there's some great value there. But look, to get into the Prezzo now, and you know, what we were just discussing there is, I always come up with this formula. You know, I did this when I was at Urbis, and you may have seen this a couple of times before, but it's the PI formula, which is population, infrastructure, and employment. You know, I still follow this even in this environment, and to me, it still sets out, you know, where I'm seeing Greater Brisbane. And look, I'm going to be a little bit more focused on Greater Brisbane at the moment. I do cover the East Coast, but at the moment, you know, I do see some benefits in the Southeast Queensland and particularly Greater Brisbane market, particularly to absorb, I think, Chris, you know, these economic shocks that we've seen, and history has shown how we absorb these, and not just Brisbane, but actually the residential market. But I think Brisbane this time is going to have a really key point, largely out of history. But look, the 4 things that I'm really keen on at the moment, and what I'm investigating, is on yields. And I think, you know, the share market's taken 40%, I think, off the top in literally 4 weeks. It took 23%. It took 12 months to grow 23%, and in 4 weeks it lost 40%. So, you know, it's still nowhere near the GFC levels, and it's going to bounce along the bottom there. But we can see as an asset class, you know, people are going to have to look for, I think, a safe yield. And residential, you know, Chris, you know, you would agree, is probably one of the better ones at the moment to put an asset in. Obviously, be diverse, but at the moment, there's some good yields out there.
You can't argue that. And I always say too, John, sorry to intersect there, but
no, please.
a bank, basically, their job is to ascertain risk. If a bank will give you 95% in today's market, they've assessed the risk so well. That shows how safe as an asset class residential real estate is. So I always say, look at what a bank will lend against it. And if it's such a high figure, it's a pretty safe asset class, isn't it?
That's probably the best explanation I've ever heard of you know, to interpret that way. It is actually very, very true. You know, would they give you that money on any other asset? I don't think so. So, you know, 100%. And look, those yields, you know, we're very lucky that we've, you know, compared to City Melbourne, they've gone through some great growth, obviously, in the last, you know, number of years, 4 years, but we've sort of been very, I guess, inflationary. And so that's actually helping us right now. Look, this future migration, and I guess a bit of a migration hub post, after the COVID-19 for me is going to be Southeast Queensland. And there's a bit of history here, which you'll see in the graphs, but that's going to drive a lot of the demand, in particularly because we're a resource-based state. And, generally when you have big chunks of economic stimulus, resources are ones that kick off straight away. So this benefits the East Coast, but predominantly I think is going to see a Brisbane kick as well. And residential supply, we've actually we're coming off at the moment on a pretty low supply base. So it's, that's something to me, which I think is only going to be able to get worse through this COVID-19 corona period, where supply is going to come down, and just see how we handle the price. So Chris, this is a graph that I always look at, and it's the house prices over time. And it gives us some really good, look back into history of, say, the red line, which is the Greater Brisbane house market, the green line being Greater Melbourne, and the blue line being, Greater Sydney. So we can see how these markets have reacted over time and, where they are now. And you can see some pretty tremendous bounce backs from that, recent APRA slowdown, as we could probably call it, or the Royal Banking Commission, in Sydney and Melbourne. And you can see how they've naturally bounced back up, and how we all interact. So pretty impressive sort of forms of growth for obviously Sydney and Melbourne, and Brisbane at the moment, obviously the most affordable East Coast capital. It's sitting at, I think at the end of February, just over $550,000 for a house, compared to, say, Melbourne, which is at 800,000, and Sydney's actually tipped over 1 million again. So this whole COVID thing for us, and the yield perspective that I guess it offers investors, that we really didn't see the bounce, that Sydney and Melbourne did. We sort of had a different growth format. And, Chris, I think you were sort of predicting, I think, this year to really, prior to seeing, this COVID thing come through in the market, that Brisbane was probably going to see some good growth this year. And it started to do that, because in literally 4 months, I think we saw a 7% growth figure come up, in the housing market. I
still think that's the case. And, I've been working in Brisbane since I started 20 years ago in real estate. And we've been saying that Brisbane's a sleeping giant, but there's so many indicators to why it's about to wake up in a big way. And the affordability thing that you said is very, very important. But Brisbane, we're expecting great things. The COVID, obviously, 19 did impact it a little bit, but I still have the exact same view on Brisbane over the 7-10 year mark as I did before.
Yeah, great. And look, it's so, these graphs, I know that history, I always look back at history and understand what happened. And we have obviously, the East Coast capital markets, we share a lot of the, these cause and effects things that we talk about in property, and, what that means for an impact. And definitely now is more of a time to actually, for investors to really be thinking, potentially in this market right now. So I'll go through this really quickly, but I can, it's one that, again, just looking at how we respond to certain, I guess, periods. This graph is the Greater Brisbane dwelling graph. So just taking a closer look at the market. And, if everybody remembers, in 1987, we had a Black Monday stock market crash, $1.7 trillion lost off US dollars, taken off the Dow Jones, and just, pretty big losses that day. So, we bounced back in that market. In Expo 88, came off a Paul Keating, Bob Hawke government, heaps of spending through those guys in that time frame, and we saw our prices, increase pretty significantly, about 118% off a catalyst event. Now, if everybody remembers, we also experienced a recession during that time. So 1991, we had a recession. Employment peaked, in 1993 to 10.9%. Yet our prices were still growing in this time frame. So even though at the moment we're hearing a lot about job losses and things like that, not everybody's losing their job. And it's interesting to look at which jobs are actually doing well and how they're going to reperform. So there's a bit of indication out of that.
Thanks for bringing that up, because that's probably the most interesting point and intriguing. People are saying unemployment rates are predicted to skyrocket or to go more. This is 10.9%. And even in that growth, you've still had growth in that market. So that's probably the most relevant point to what we're seeing, I feel. And people are most scared of unemployment rates.
Yeah. And look, it's understanding, you know, I always believe that you mentioned it before, is it's not just one factor that changes property. There's lots of things that change property. If everybody remembers back in the 80s, you know, they had, you know, 20% interest rates, 19% interest rates. Like this was probably the period that it started to come down a little bit, but it was still pretty high. It was still like double-digit interest rate through this period. So, you know, we also saw, and I'll show you a slide in a second, but you were right. Like we had huge unemployment across the country, but we saw a lot of migration movement. And so that just shifted where people were invested and people came up to Southeast Queensland. So look, we went through a bit of a relatively flat time in the 90s, unlike, you know, the Sydney and Melbourne, but we did have an Asian financial crisis that came through here. We then had the introduction of GST through the Howard government. And then we experienced, you know, a pretty big pickup here of 110%. So, you know, this was probably on the back that I think this is probably the most significant cycle because one, I was old enough to probably be involved in the property market at this time. But two, you know, we saw Sydney become, you know, I guess a powerhouse for property. It was the most expensive market in the country. It saw Melbourne pick up considerably, and then following suit, we then saw Brisbane pick up. As you know, the saying would go, I could move to Brisbane, sell my house in Sydney, buy a car, buy a boat, and buy a nice house and not sit in traffic. And that's what literally happened. So we saw a lot of people migrate. We had a SARS outbreak as well. Everybody remembers 2002, 2004. And then on that back of that migration that was still coming out of Sydney, we kept on growing. So we ended up picking up again, and we jumped another 42%. And look, our prices were still, you know, sub 500. They're still sub 450,000. So still relatively quite cheap to these prices now. But then we had a GFC, and that GFC, look, it saw a slump in the prices go down by about 7%. So this is a really good indicator for me, Chris, because I'm already starting to hear and seeing the media, and you know, it's to me, the smart investor at the moment is not reading the media. They're looking at the catalyst signs, and the catalyst signs, you know, for me is that even like, you know, there's always been a lot of talk around these times about major price drops and things like this, but even in the GFC, we didn't see it. We saw only 7% slump.
And that's John, actually just on that, you said 7% of the GFC. People are making the most outrageous predictions, but two things we said before, in our price point, at the worst point, it was 7%. People are predicting 3-4 times that, which I think, you never say never, but I'll say that's never going to happen in what's currently happening, especially in our price point. So the two things, you've also said that employment rate of 10.9 and this, I think they're the two most commonalities and factors which we're going through at the moment, which people are looking at the past history as a forward indicator of what's going to happen in the markets. And these are very, very good points for people that I really want them to sit down and actually think of exactly what you're saying here. So I think they're the most relevant.
Yeah, exactly. And look, I think nobody can discount what I think is probably going to be the most important factor. And we learn a lot out of the GFC. And I think our government at the moment, there's a lot of things happening around the world. And I think our government's actually done some pretty amazing things. One, we've actually stimulated at the front. If everybody remembers the GFC, the stimulus really didn't come to after. So it was more like an effect later. And so we're going to see, at this moment, we're seeing stimulus at the front end of it to try to, you know, I guess, weather an economic hibernation, as they're calling it. Whereas in the GFC, it was all about trying to stimulate it back up again. And so we saw that stimulus. If everybody remember, we saw the first homeowners grant come in. Property is always stimulated. You know, I think that's something that we're all going to be thinking about now is once this sort of dust settles and the signs are looking pretty good at the moment with a number of new cases and everything compared to a lot of countries around the world, we're positioning ourselves pretty well for people to really park some money in Australia to get some wealth. And then also we know that the ignition is going to be government stimulus.
Yeah.
And that's going to come again. And so we saw that stimulus back here and it popped again. It jumped to 12%. It popped up again. So it went from only a 7% slide. And if you remember, like there was huge talks of 40% declines in property and all these sort of things. And it just slid 7 because as an asset class, it's not capable of doing it that rapidly. You mentioned it before, like we've got so many factors that one thing that is really important. And I love this, Chris, is that as humans, we all need a place to live. Like it's still a fundamental thing for us. Like we need a roof over our heads and food on the table.
You know what I say, and I wrote a lot about this in my book too, John. I say to them, I'm not Nostradamus, I can't predict the market, but I can tell you one thing categorically. The market will grow, stay the same, or go down slightly. But over a period of time, it will always grow. One thing I can categorically guarantee you, we're going to pay a lot of tax in this country, and we're going to have a shortfall in retirement, which means we need to invest and plan for our future. This is a long-term proposition. And I always take every view when purchasing property. I always look at those two things. And clients go, I never thought of that. You're paying full tax, or you're paying a lot of tax, and you still have a shortfall in retirement. Give me one asset class, especially in a market like this that you're more comfortable with, that a bank's more comfortable with, in an environment that's 0.25%. So I think of all those things. I say to clients, when you consider all those factors, this is actually a great time to set yourself up for retirement.
Oh, it is. And look, the swing out of this is incredible. You know, like to jump back into that mode. I think, look, you know, the good thing is that there's a number of asset classes that I'm probably a little bit worried about out of all this, because technology is obviously taking, you know, we're doing things like this now where, you know, we're probably going to see office and retail change quite considerably. But the good thing is that we all need that place to live.
Of course.
Australia is going to be, you know, the way that we handle this current crisis or catalyst, I think we'll probably see Australia become in huge demand across the global, you know, across the world. So there's going to be some big factors here for us that we're predicting. Look, we saw a flood in 2011 up in Brisbane. It did impact our market. We saw prices drop 8%. But then, you know, from that, we then recovered. And this is where that 22% or 28% in the housing market sort of came into a period of growth. For anybody that remembers the last probably year, we saw APRA and the Royal Banking Commission, and this impacted, it only impacted the market out of volume. So what was actually happening, the price slump that we saw, particularly in Sydney and Melbourne, what we were actually seeing was not actually price decline, because we've all known that values have actually sustained itself. It's actually the volume of what was moving in the market at a different price point. So if you're selling, like you said it before, you're selling a band of price that is working right now, that $400,000 to say $800,000 mark or $600,000 mark, you know, that's what was mainly transacting. So, because that's what the banks were comfortable in lending.
And affordability is king. And one point that you've mentioned, and I really want people to resonate with it, it's about having the right information and being educated. So everything that you're saying statistically backed up and proven, but people hear the media and they freak out over it. But if you actually understand exactly every part of what you've been saying, it makes you think of investing in real estate differently. It makes you understand it. So when Buffett was saying do the opposite, the people that are educated and have the right information are comfortable with doing the opposite because they had the right information, which is paramount to making a good investment decision, isn't it?
Correct. And look, you know, for me, for the years that I've worked with a lot of developers, I've always found the smartest developers that actually make the most amount of money. Because look, I've worked for a lot of developers. Not all developers are created equal, you know, in this industry. But the smartest ones I find really capitalize in these environments. They've got the ability to purchase through cash, and they capitalize in this time. And I'm seeing this already happening, where we're starting to see the not so robust developer, Chris, starting to walk away, and you know that they just haven't got that background with them, and the true developer coming in and capitalizing. And to me, the investor, like you're saying, is the same thing.
And like Urbane as well, you're doing that, but also passing that on to the investor. So a developer like yourselves that are being able to do this, sustain these conditions, passing these great incentives on, which I'm so excited to announce at the end of this presentation what they are, and giving the investor a great opportunity to make some good money, even in these times.
Yeah, exactly. So look, I'll just end this sort of research, but just one of the things that I think is really important, Chris, is about this economic push, you know, like, this migration push. And if I can bring up the same sort of figures that I just showed you then, look, I think the good thing is that we're seeing, you know, this sort of period of like, basically what this graph shows is migration across Australia. So if you're below this line here, you're leaving your state. And if you're above the line here, you're entering a state. So you can see how pretty much New South Wales, or Sydney, as we would say, is always actually in what I call a negative net interstate migration. It's always losing more people than it's gaining. And you can see it sort of mirrors Queensland or Brisbane, or Southeast Queensland, I should say. So we can see how Melbourne then interacts. And, you know, if you remember back when I was talking about the recession and unemployment, a lot of where that major unemployment was occurring back in that recession was actually in New South Wales and particularly Victoria. And you can see how, look, we saw these people leave, and where did they come? And you remember back, we were still growing. We grew at, in this time frame here, 118%. But it's because we had people. And same thing during when Sydney became the most expensive market in that 2000 period. It became people. And even now it's people, and I think as we see household debt, because to me, one of the key things is in all this that's going to happen, I think people are going to wake up and go, I don't want to have problems with household debt, and investors are going to be looking more and more about their yields. And so there's a big myth that people in Sydney and Melbourne earn more than people in Brisbane. And I'm telling you, that's not the case. But the affordability thing that we're talking about today is. So I think the fact that we've got that affordable market is really going to play a lot of factor on yields. And look, it brings me to, I'm just going to touch on, Chris, a community that we're really big on, and a project that we're really big on. And a lot of your clients may have heard of an area called Greater Springfield up in Southeast Queensland.
It's Australia's sold in the area as well.
Yeah, it's Australia's largest master plan community. Look, we've got a project there. We've been under construction in this project, and the guys, Reventon can give you obviously a lot more information on the project. So I'll only touch on this very quickly, but our house and land packages are sub 500,000. They're starting at 473,900. The key thing that's different about this community, it's developed by Marquee as well. So it's a Marquee Urbane project where we're controlling our outcome. We're not, we're able to, this is how we're able to work these incentives with Reventon as well. So this just gives you an idea of its location, but it's right there in Springfield, in Greater Springfield. So, we talk about that pie formula, population, infrastructure, and employment. And this is why we acquire sites like this, because it offers that security. And in markets like this, that's what you want. You want that ability for what we're going to see as growth in what we talked about.
Affordability is king, and it's got great rental yields as well. So that's always going to be strong in any market.
Yep. So like walking distance to a school, 5 minutes to a shopping center, hospital, trains, everything, and then only 25 minutes away from the CBD, connected by a freeway and a rail. So really, really, great location. The project, as I said, it's 43 lots. The one thing that I need to make sure that everybody takes away on this project as an opportunity is that it's a big lot development. So the smallest lot in this project is 450 square meters, and the smallest frontage is like 15 meter frontage. So really nice, wide, flat blocks, nicely elevated. And to me, that's very different to a lot of communities that generally offer smaller product or smaller lots.
And the lots are what so people understand, the lots are usually 300, 350, so it's substantially bigger.
Substantially bigger without the price point. And this is why we've been, working at the moment as the site's under construction. We're working very closely with the local market and obviously moving that, because it's an owner-occupier product. It's an owner-occupier package. You can see that the frontage gives you space between the houses, and it gives you a backyard. And that to me is capital growth and a future selling opportunity to exit it if you had to later. So it's going to attract an owner.
So in summary, what we're doing here, we've got an owner-occupied product which we're selling to an investor, which can be on-sold to both owner-occupiers and investors, which opens your market up, gets you a much higher rental yield, and it's a much more appealing investment in all categories, which is why these are so good for our clients.
Yes, correct. Absolutely. And look, we focus, all our projects are focused around, this pie formula as we talk about, but largely around where there's already a significant amount of infrastructure investment, because that just promotes people, it promotes jobs. So just quickly, a little bit about Greater Springfield, but, it is Australia's largest master plan community. It's really well located in between Brisbane and the Gold Coast. So nicely connected, easy to get to via freeway, unlike Sydney. And it's the same distance from like a Sydney to Parramatta, just without the traffic. So, it's a little bit easier to get to, but it's a significant community and one that, I think to date they're looking at spending, in the future up towards 85 billion into it as a total investment. So I think at the moment they've spent about 17 billion in the area. So there's still a long way to go, but a lot's there at the moment. But the key thing for us, it is quite a diverse market. It's, It's one where the median house price is 500,000. That's for the existing. It is really well positioned in Brisbane. So this is the CBD here. You come down here in the Centenary Highway, you hit this greater Springfield area. You've got the Logan motorway that connects you to the Gold Coast. You can go west to the Amberley Air Force Base. It is just centrally located in that Southeast Queensland corridor. And then when you're looking at it from a job point of view, it's just surrounded by some pretty major job markets. You know, they're predicting in Greater Springfield up to 52,000 jobs to come into that market by 2030. So it is going to be outside of the Brisbane CBD. This is going to be a major employment node. And the reason for that is that the road network, as I just showed you before, is there. So you need this road network to be there to be able to promote jobs. It's not like it's coming. It's already there. The infrastructure.
Great connectivity already there, which is obviously,
100%.
yeah.
So look at this project. It's located just up here. It's opposite a school. There's the key thing with Springfield. It's surrounded itself with health and education. And they are two great job markets, health and education for this country. And so you can see where we are up here. We're into this precinct down here, which is the health precinct and education. And education is mixed all through this with retail and other employment formats. But just to give you a quick idea of the health precinct, brand new Mater Hospital delivered a number of years ago. But it's going to set itself up for another another public hospital in the future once it gains a bit more population growth and retirement. And then education, currently at the moment, there's 17 early childhood centres and there's 11 schools, both public and private, already there. So this is why you can see we're selling a lot through the local market, because it is just perfectly positioned with the infrastructure already there. If you haven't been out there, Chris, in a while, this is something to probably check out. They've just opened this up, a $56.2 million sporting field complex. It is massive, 225,000 square meters. It's like, this thing is just open to the public, full of sporting events. So they've just literally opened this up and connected to the train station just opposite the health precinct. And obviously for the Melbourne AFL footy fans out there, even though the season's not happening at the moment, but we've got a brand new stadium for the Lions under construction there, which I'm particularly happy about. So as a Lions supporter, but you know, like this is a great venue, and it's 70 million under construction, still going ahead. And this is, again, just all what's happening within 5 minutes from the reserve. So I'll quickly just finish off with this, Chris, because I know I've been talking forever and we want to get to these points, but this just shows you the value proposition of what we offer and I guess what my role is within the family. But you can see here, this is the reserve through here. It's 252,000 for a 450 square meter allotment. And then we've got just the competing projects. We're always very transparent. You know, we try to give as much information to our clients as possible on what's happening in the market. And obviously if we're offering that value guarantee, we want to make sure that we're doing our own research. But to compare a 450 square meter with the frontage and being flat, all I've done is gone through every single project for a like for like, and I've just given you what the land price is in all those projects. So Chris, if you want to be able to give them all the information that I've collected, happy for you to share those prices. You know, you guys get all that information. But you can see here, like Stockland's project, $55,000 more expensive. Primo, another project just down the road, 58. You know, another Lend-Lease project, Springfield Rise, 58,000, and Brookwater, a golf frontage community. Again, it's a lot more expensive, but it just goes to show that within a 5 minute radius around our project, just the land component itself is in such huge value comparison.
So just to summarize, you're between just under 55 to 160, $2,500 difference. We're developing a owner-occupied product, which is sold to an investor, which has high yields, and we've got a bunch of incentives as well.
Correct. That's it.
I just wanted to point them out because I guess as we're going through this, I think we go through this quick, but we actually are not actually stopping and really understanding all these points and what an amazing opportunity this is for our clients. Because think about the difference, what good capital gains you can get if pretty quick. You can get a good tenant in quick, you can sell it. So there's a lot of advantages to our clients. I just wanted to point them out. Sorry to interject.
No, that's look, and that's really important. It is, you know, for you and I, we talk about this every day, and it's good that we can slow down and make sure that we focus on the key points. And look, the key thing in this market is about being, you know, to show value, particularly in land. And land to me is a real opportunity in South East Queensland. We are not producing enough of it. It's very difficult to produce up here, vacant land. Unlike other states, we have a very difficult time of actually getting through a lot of the hurdles that we have to. Land is something that is going to be a key focus in this region for growth. And particularly as we see with these stimuluses that are coming out and the change environment, Springfield for me is going to be a market that I think will probably benefit greatly. And as an investor myself, and obviously with the family, this is something that we're going to be looking at more projects in this area, because it's just got so much value opportunity in this current climate.
And you mentioned previous as well, the migration is very, very popular here as well. The infrastructure boom, there's a job boom there, there's great connectivity, the airport upgrades, and all these things that are really underpinning Brisbane and Southeast Queensland particularly to really take off. And coupled that with great prices, good incentives. I mean, that's why for me, I'm so excited to be offering this to our clients, because I know that it's going to be a great investment. And I'm also excited to be involved in these projects myself, because I'm personally investing there as well. So,
yeah, I mean, look, and that's, I think for us, look, it sounds really easy when we talk about it, like off the tongue like that, Chris, but it's actually backed on a lot of work and a lot of time in the market and taking these opportunities. Yeah. And, you know, that's hence why we can exclusively give you, you know, and Reventon this opportunity. We're not in the market with this project with a lot of people. We're obviously working it locally. It is something that, you know, we've sort of been able to work with Reventon on and bring this to you guys. And it's under construction. It's going to register in June. And we really do think it's probably, I think it's a good project for the timing, where, you know, you'd be able to probably hand over the home, you know, roughly around the end of the year. So, and, you know, potentially early next year, depending on obviously when you purchase it. So it's, to me, it kind of fits in a time frame that we'll probably see the swing in the market. And that, to me, this is that timing communication that we were talking about before.
Definitely. So now, Jon, first of all, thank you very much for that great information, taking us back to many different cycles as well to give people an understanding. So thank you for that. What I'd like to do, with your permission, is just cover the incentives that Reventon exclusively has now with Urbane Homes. Is that okay?
Yeah, for sure. That'd be great.
So I'd like to cover the 4 incentives, and for everybody that's listening to this or will listen to this, we'll provide a lot more information around all that anyway. So I'm just going to cover point form. And Jon, if you can just elaborate briefly on each point. So we're offering a job loss deposit guarantee. Can you tell me a bit about that?
Definitely. So we're very conscious that at the moment that it is sensitive, and this is probably one of the most sensitive topics is around obviously everyone's job prospect. We wanted to be able to give, you know, the security for your customers exclusively, that if any event occurred that we're not interested in keeping the money, we want to be able to give them the opportunity that if something were to happen where they weren't able to proceed with the purchase, that we would just refund the money 100%. So Marquee as the land developer, 100% refund the money if there was a job loss, you know, and they couldn't proceed. And
as you said before, the people that are ready to that are cashed up and have been able to take advantage of these opportunities, and developers as well, only they can offer these sort of incentives, which is very important.
Correct.
5-year rental guarantee.
The 5-year rental guarantee is, again, another piece of mind. We're so confident that we look, and because we obviously run our property management, we're pretty confident currently in the rental market. We are still renting, even though we've seen the way that we rent different, you know, we've gone more online, but we're still renting quite strongly. But really another peace of mind for people, which I think in this time frame, just to be able to cut through the noise and give them certainty that they're going to, at a minimum, going to get, you know, particularly at the reserve, they're going to get at minimum a minimum amount per annum, and that we pass on in that rental guarantee as well. We pass on the extra that they would get. So for us, it's just certainty. It's giving us, we're confident that we're not going to pay, we're not going to have to pay, but if we did, for any uncertain value, that at least that's there for you.
It comes down to what we discussed before, and one of the biggest reasons I think Reventon does partner with Urbane, you back your product to the T, which is very important. Price drop guarantee. Tell me about that.
Look, the land price guarantee, or the price drop is again, Marquee's controlling the land, but for any reason that the developer chooses in the future to reduce the price of, say, a like for like, we're willing to be able to obviously rebate that price difference for the customer. So if the price was offered cheaper at a later date or within that 12-month period, we would reduce the price and give them the certainty that they're going to get the same deal, that deal is happening right now. So
you're that confident in this current climate that your prices are that well priced and cannot even go under your price drop guarantee.
Correct. So even if the competition decides to drop its price $60,000, as we saw in that research, and we had to sort of come down to be more competitive, we would stand by that.
And even if it is 50, it's only 5,000 less, because 54,950 was the cheapest.
Correct.
Prices, up to 162,500. So I don't think that will happen. Now, zero stamp duty.
So look, the stamp duty, again, we've looked at this and we figured as an incentive for Reventon and their clients, and obviously the relationship, we're willing to invest in our clients in this time frame and give them that stamp duty. So for us, it's an extra incentive that, the other ones for me are bonuses. They're really there just as more of a comfort barrier. This is really something that, again, in this time frame, to be able to go and take an incentive at the moment in this climate, that's one that I think you should look after. It really makes the project on a cash flow basis, work really well. And that's one that we're willing to invest in with Reventon.
I agree, but also too, I think we can't overlook the fact you back your product to the T. So just in summary for what we said at the start of the program, as close to a risk-free investment as possible in today's climate. If you were to lose your job, you get a full refund before the property is built, which is unbelievable. So you've got no risk there. You've got a 5-year renter guarantee if unable to secure a tenant. All of this is obviously done through internal. There's also a rent gap. So if you get more rent, they'll actually be passed on to the investor. Price drop guarantee. You will not be able to find another block of land like for like that's cheaper. If you do, you'll receive the difference from Urbane or associates. And zero stamp duty to help the buyer get into the current market. So if we're summarizing all those things, we've looked at unemployment rates, what's happened in the past, which has gone as high to 10.9%. We've looked at what GFC has done to the marketplace. We've taken all the main concerns and we've secured against them because you back your product 100%.
Yeah.
And as we said, in today's market, you're only going to find these opportunities in today's climate. In 6-12 months when this isn't around, there is no way you will find these opportunities. But second to that, you've got someone who believes in their product as much as we do, that's actually selling it to our clients and offering that as an investment. So first of all, John, thank you very, very much for your time. To all of our clients that are watching this and that are going to watch this, there will be some information and links across to get in touch with reventon.com.au for this exclusive offer between Reventon and Urbane. Thank you very much for your time, John.
Thanks, Chris. Thank you so much. Thank you, Reventon.
Have a great day. Thanks.
Thanks.